So friends, today we will be starting a new chapter. It is called the Financial Analysis Techniques. This is part of the Financial Statement Analysis segment in CFA Level 1. So, Financial Analysis Techniques. What do you mean by this financial analysis? So friends, whenever we are trying to analyze any business, there are two aspects to it. One thing is, we want to find out certain absolute parameters or absolute analytical factors about that company. And there are some relative comparative analysis that we want to do about the company. And both the absolute factors and the relative factors may use financial data, may use some qualitative data like news. In the same way, relative factors also may use financial data and also some qualitative data, non-numerical data, right? For absolute and relative analysis factors, when we are using financial data, right? When we are using financial data, they fall in the category of financial analysis techniques. Okay? So let us define financial analysis techniques. So financial analysis techniques are methods and techniques applied on the available financial information of a business to make interpretations about the security representing it or its underlying business. So financial analysis techniques are methods and techniques applied on the available financial information to make interpretations about a security or its underlying business. And the financial information obviously is pertaining to the underlying business only. It's financial statements, basically the cash flow, the balance sheet, the profit and loss, etc., etc. Now we were talking about absolute factors and relative factors. Let's take some examples of absolute analysis and relative analysis now. Let's say an automotive company has a return on equity of 35%. And its debt to equity is 0.2. Debt to equity means the ratio of debt and equity. Return on equity means the ratio of earnings and book value, right? We will get to these terms in a very short while. This is earnings to book value. This is debt to equity ratio. Now, in absolute terms, the debt to equity ratio is quite good. The debt is low basically, because you see it's 0.2. That means 2 by 10. This is the ratio of debt and equity. So this is a good ratio to have. And 35% return on equity under this condition of low debt to equity is also very good. Now what we are doing here, friends, we are actually analyzing in absolute terms. This is financial analysis in absolute terms. Now, what is a relative analysis? Let's say there is another company we are comparing this to. So, ROE of another company is 30% and its debt to equity ratio is 0.5. Obviously, if you compare this company with this one, the number of the first analyzed company looks more attractive. This is also good. In its debt to equity of 0.5 is not decent, not bad. In absolute terms, ROE of 30 under a debt to equity ratio of under a low debt scenario like this is quite good. But if you compare both, then the first company, that is company A, if you term them company A and B, company A seems to be more attractive, right? Now, when doing financial analysis, a few things have to be considered. The first thing that has to be considered is, what is the purpose? What is the purpose of the analysis? For example, are we trying to find the intrinsic value of the company? Are we trying to find some relative pricing parameter of the company, like P ratios or P growth ratios? Are we trying to understand the debt scenario of the company? So what is the purpose? What is the purpose of the research? Number 2 is, what is the data available? So, is the data that we need found in the profit and loss statement? Is it found in the cash flow statement? Is it found in the balance sheet? Or is it not found in any of them? You have to check the notes in the annual report. Or you have to check the quarterly reports for it. This is what we have to understand. Third is the level of detailing that is required. So for example, we can say the revenue of a company is 1000 crores. That is one level of detail, right? And we can also say that the company operates in 3 segments. And the segment revenues are 500, 300 and 200. This is another level of detail. Then we can also say that the 500, out of this 500, 50% comes from USA, 30% comes from India, 20% comes from Europe. That is another level of detailing. That is, we are going on adding the details. Now it depends on whether the data is available or not also. There are limitations to this also, right? The fourth point is, what are the factors that will help us do our required analysis? So for example, if we are trying to find whether a company is overvalued or undervalued, we need to find out the intrinsic value of a company, and we need to find out what is the price of the company at that stage. If we compare them, we can easily understand whether the company is overvalued or undervalued. Again, for example, if we want to understand the debt scenario of the company, we have to bank on debt to equity ratio. We have to bank on the interest coverage ratio, right? These kind of relationships will help us. Again, for example, let us see, let's say that we want to understand whether a company is asset light or asset heavy. There, what we have to find out is, for example, revenue to fixed asset ratio, or profits, that is net income, to fixed asset ratio. This can give us whether the company is asset light or asset heavy. Right. Again, there is a fifth factor also. We would write that is limitations to our analytics. I'll take a very obvious example, friends. Let's say we are searching for small caps with potential of growth. Small caps with huge potential of growth. Now let's say the market cap of the company is 100 crore. Right now the market cap of the company is 100 crore. We have the P&L statement, the numbers are good. We have the balance sheet, the numbers are good. Cash flow statement, still they are trying to decipher and get into a free cash flow state, but they have not yet gotten into. But profit and loss statement says they are growing at a good healthy rate, and balance sheet is also quite qualitatively quite in a good space. But can you really say that after 10 years this company will become 5,000 crores? What is the assurance about it? There is a limitation to the projection here, friends. So this also we have to understand, that how much we are able to predict or how much we are able to interpret a data. Till what limitations? Limitations in terms of time and space both. In terms of detailing and in terms of relative and absolute, in all these factors there are certain limitations and certain accessibilities also. So you have to understand where the limitations lie and up till where we are actually being speculative. So that's about it. Now we will try to construct a flow or a process through which the financial analysis is done.